There are multiple issues that have weighed on the market recently and likely contributed to the decline in the MSCI ACWI during the third quarter. I think the most notable themes have been higher inflation recently and the expectation for higher interest rates in coming years. While rates are very low and will likely remain low even after rising from current levels, the market is digesting the expected change of direction in monetary policy around the world. Slowing growth and policy changes in China and ongoing impacts from the pandemic are likely factors as well. While the global growth portfolio performed well on a fundamental basis, policy actions in China weighed on the share price of both Tencent and Alibaba, causing the portfolio to trail the benchmark during the quarter. We've realized strong returns from both businesses since the inception of the global growth strategy, but decided to exit the positions in July. Given the global opportunity set available to us, we felt there were easier ways to position the portfolio for mid-teens earnings per share growth in the coming 3 to 5 years. Accenture was one of the leading contributors to the global growth portfolio during the quarter, and a great example of how the pandemic has accelerated the growth of some businesses. For the fiscal year just completed during the calendar third quarter, the company reported a record 20% growth in new business bookings. While this is certainly reflective of the value of Accenture's services, we also think it's due to the sustained growth and demand from companies looking to modernize and digitally transform their businesses. Some businesses are working to close a competitive gap, while others are trying to extend their lead. Regardless of the specific aim, Accenture is a trusted partner, and you can see that in their business results. We added a new position in ICON during the quarter, making it a significant weight in the global growth portfolio. After its recent acquisition of PRA Health Sciences, ICON is now the leading clinical research organization, or CRO, in the world. Pharma and biotech companies continue to spend more on R&D and to outsource more of their clinical trial work, while leading CROs are taking market share. ICON has been growing faster than its peers, and we think it will be even more advantaged given the way the world of clinical trials is evolving. We think the business is positioned to deliver mid to high teens earnings per share growth during the next 3 to 5 years. With an aim for and expectation that the global growth portfolio will deliver mid-teens earnings per share growth during the next 5 years, we think the earnings growth of the portfolio will make it less exposed to changes in the overall market value over the long term. If during the next 5 years, for instance, the market PE and that of the portfolio were to decline 20% as interest rates rose, mid-teens earnings per share growth would still support a double-digit investment rate of return during that period. The benchmark rarely delivers that level of earnings growth over the long term. We think a sustained high earnings growth rate can overcome market challenges.